Okay, welcome back, everybody. Today is Friday, and today what we're going to do is we're going to start off by finishing up going over the statement of cash flows that we were talking about on Wednesday when we ended class. So we'll start here, going over the statement of cash flows a little bit to wrap up chapter 6, and then we're just going to kind of just have like a kind of open-ended discussion type thing and just kind of move through the first 6 chapters and review some concepts. And then we'll do more of a detailed approach on Monday, mainly because I have not had an opportunity to actually create the exam yet, so I can't do it as detailed as I would like today. So um, we'll start here, do a little review. Like I said, just hit the main points, just try to just retouch on some things, and then Monday we'll have another review, and then maybe some stuff we're having issues on. We'll try to work through some stuff, and then Wednesday obviously will be the midterm. So Monday I'll have the exact format of how many questions, how many is coming from each chapter roughly, and stuff of that sort. So expect more detail on Monday. Um, we're going to just start with this statement. Let me just make sure. Okay, I am recording. All right. So once again, this is the statement of cash flows for the Village of Riverside. This is pertaining to all the entries I'm sorry. I do this every morning in my 8 a.m. class, so I apologize. Seems to be my routine. I see that one was on, so I was thinking I'd already turned this one on. Better? Cool. All right, so statement of cash flows. So for the Village of Riverside, we went over most of this on Wednesday, but let's just look at it again. So we know this is a statement of cash flows that adheres to GASB standards. So we would expect to see the 4 categories of cash flows, and then at the bottom, the reconciliation of operating income to net cash provided or used by operating activities. So once again, we'll have the business type activities, the enterprise fund, and the governmental activities for the internal service fund. So once again, we'll start with the cash flows from operating activities. We know this is just your operating expenses, stuff we would expect from people like our suppliers, paying our employees, receiving money from our receivables, stuff of that sort. We know we have 2 financing sections, one being the non-capital financing activities, the other being the capital and related financing activities. The main distinction there is obviously what the money's being used for, whether it's working capital or to purchase fixed assets and stuff like that. So that's the main difference in those. Cash flows from investing activities. Recall these are going to be strictly investing activities that we see here. One other thing I want to point out and just remind everyone, remember that GASB requires for the operating activities that we have to use the direct method. So meaning if money was paid to suppliers, then we're gonna put it exactly how it was. If we paid $50 to a supplier, then we're gonna have cash paid to suppliers of $50. So it's simple, directly as it states. So then let's get back down here to the reconciliation of operating income to net cash provided or used by operating activities. And as I was saying on Wednesday, all this reconciliation is the indirect method. So if we're used to the statement of cash flows from our for-profit from FASB, like we know for the operating activities, we can prepare it either the indirect method or the direct method. So all we're seeing here at the bottom with this reconciliation is the indirect method. So don't let the whole saying of what it's called the reconciliation kind of scare you, because it's really not bad. So let's just start with it. So first thing, let's make the main difference here. With GASB, we start with operating income, right? When we do this reconciliation. FASB, we start with net income. So if you recall, that's with it starting with operating income for GASB. That's why it's so important. Remember on that statement of revenues and expenses and changes in fund net position that we start with operating revenues, then with non-operating revenues and stuff of that sort. So we want to make sure we have that line break there for operating revenues. So we're going to start with that. So we can see that once again we're going to just stay with the business type activities column for simplicity here. So we know, if we recall back for that statement of revenues and expenses for these proprietary funds, that the operating revenue was $396,200. So we know that's our starting point when we reconcile, right? So we start there. And then the next thing we want to look at is for any non-cash expenses, right? So what again are some examples of non-cash expenses?
Depreciation, amortization, and
Depletion. Right. So those are non-cash expenses because those are systematic ways of just matching expenses and stuff throughout the period. So and depreciation is going to be the main one we're concerned with. Okay. So because that's something we're going to see verbatim because all these places are going to have fixed assets. So let's just say depreciation. That's what we're going to be mainly concerned with. So obviously, if it's a non-cash expense and we're accounting for it as an expense within a period, how should we treat it when doing this reconciliation? Should we subtract it or add it back? So we need to add it back, right? So we're always going to add these non-cash expenses back because there was really no cash outflow, no cash outlay. So obviously here, depreciation expense, we can see we added the $122,800 back because there was no cash flow associated with that expense. After that, then the next thing we're going to be concerned with is the changes in assets and liability accounts, right? So we're gonna need to look at what sheet to pull this data from. If it's changing in assets and liabilities, what sheets are we going to use to pull that data?
We're going to use the balance sheet, which is called net position.
All right, statement of net position. Right, awesome. So we're gonna start there. So obviously we're gonna have to see the balance sheet or statement of net position from January 1, and we're gonna have to see it again for December 31st, right, to see what those changes are in those assets and liabilities from the period, right? So with those statements that we have for comparative purposes to build this, we'll see what the changes. And the first one here, we said changes in assets and liabilities. The first one we're concerned with is accounts receivable. They're saying here that there was an increase in customer accounts receivable from January 1 to December 31, right? So remember the trick that I said on Wednesday? If it is a debit throughout the period, if it, like say, accounts receivable is an original debit, right? So if it increased by $4,600 during the period, then we've debited it, right? To make it increase. So if it debited throughout the period, then we need to subtract that out, right? So that's why we're seeing the negative 4,600 here. Increase in interfund receivables. So once again, an interfund receivable is an asset. Assets are original debits. If it increased, we had to debit it within the period. So the debit needs to be backed out, right? We need to subtract that out, right? So that's why we're seeing negative $80,000. Next, increase or decrease in inventory. So obviously it's out of parentheses here, so we know it was a decrease in inventory. Inventory is an asset, right? So when we originally record inventory, we're debiting it, right? So if it's going to decrease in the period, we've obviously credited inventory, right? Because it's went down, it's been reduced. So if we credit it during the period, then we have to add that back, right? Because we add back credits. That's why we're seeing the $6,500 being added back. Same thing here, increase or decrease in accounts payable. Well, we know here it increased, right, in accounts payable because it's not in parentheses. So if it's an increase in accounts payable is a liability. Liabilities are original credits, right? So if it increased, we had to credit that account. So we're going to add that back, right? So that's why we're adding that back. Increase in accrued liabilities, same thing. Accrued liabilities is an original credit. If it increased during the period, it was a credit. So that's why we have to add it back because we add credits back, right? And then it's simple. You literally just go through the math. You take the $396,200, you add back what's supposed to be added back, the non-cash expense to depreciation, and then you add or subtract the change in assets and liabilities. Remember with the trick of if it debited throughout the year, we subtract it. If we credit it, we add it back. And that is the easiest formula to remember. Debits, you subtract, credits, you add back. And it will work every single time. So that's the easiest way to do the indirect method or the reconciliation. Same thing. This works for GASB and FASB. No difference. And then there's the net cash provided or used by operating activities. Notice it matches the net cash provided or used, $465,800. So with these changes, so that's how you reconcile back to what operating income was. And so operating income should be able to reconcile back to net cash provided or used from operating activities, right? Because obviously operating income. But for FASB, it's net income because that's throughout the operation. We're concerned with net income. Here, we're concerned with operating income. So does that make sense? Pretty much. So GASB statement of cash flows. Just know there's 4 categories. Know what they are. Just know what items belong in each. They're pretty straightforward. What belongs in each. And just remember for the reconciliation, start with operating income, and always add back your non-cash expenses, depreciation, and then you'll take into account changes in assets and liabilities. And in order to do so, obviously we have to have beginning period balance sheet, ending period, and whatever changes, and then add or subtract the debits and credits, right? So not bad. So let's go ahead and just get off that. That wraps up chapter 6. So not bad. I mean, that's the proprietary funds and all the statements that accompany them. So now let's just go back and just take a look here at just some of the stuff that we've covered. So chapter 1, let's pull this up here and just see what we got here. So this is just the introduction to it. Okay, so let's just get in here a little bit. So we know what's the main difference between like accounting for governments and not-for-profits as opposed to for-profit sectors.
You have a greater responsibility.
Right. So because the government has to be accountable, right? The accountability is key. So greater responsibility. So obviously, if we have a greater responsibility, then we have to change certain ways we have to account for some transactions, right? So obviously that's where GASB comes into play. They've changed the financial reporting requirements because it's for the benefit of the users, right? The users are who we try to tailor the financial statements to for their purposes of being able to pull and generate data and information off those for investment purposes or just whatever the reason might be. Maybe they're just curious to see where their money's going or how it's being spent. We know sources of revenues are different because most of the times with governments, they derive most of their money from taxes and just mandated transactions. So that's a big difference. We know that the going concern of a government is a lot greater than it is for a for-profit business because it's backed by the taxing authority of the government. So that's a good thing. So the going concern is different. So once again, FASAB, if we remember this, FASAB is just like the agency above the GASB and FASB. So they pretty much set all the federal things here. So that's important to know. Let's talk a little bit about the authoritative literature. So GASB has authoritative literature, and we know that's where we seek out for guidance on transactions, right? So we're going to start with the GASB's authoritative literature, the codification, right? And we're familiar with that. We won't get too much into that. Let's look here. So let's just look at the little review here. So we know this is going to be the required content of a state and local government financial report, right? So first, we have management discussion and analysis. Next, the basic financial statements, government-wide financial statements, which we have statement of activities, statement of net position. That's it, right? It operates on an accrual basis of accounting. Then we have the fund basis financial statements. Starting with governmental type funds, we have the balance sheet, statement of revenues, expenditures, and changes in fund balance. And then we have the reconciliation from the government statements to the government-wide. Remember, because the governmental funds operate on the modified accrual basis, current financial resource measurement focus, and the government-wides operate on the full-blown accrual, on the economic resource measurement focus. So that's why we have to see that reconciliation there. The proprietary funds, the ones we just covered, we know that there's 2 of them. Internal Service Fund, and the enterprise funds. They operate on the accrual basis of accounting. They have the statement of net position, statement of revenues, expenses, and changes in fund net position, and a statement of cash flows. Next, we know we have 4 fiduciary funds, which have the statement of fiduciary net position, statement of changes in fiduciary net position, and then lastly, we have the notes to the financial statements. And then obviously required supplementary information other than MD&A, right? So let's talk a little bit again. Government-wide statements. Statement of net position is similar to the balance sheet. Statement of activities, similar to the business income statements. Fund financial statements, obviously, they're detailed reports on governmental, proprietary, and fiduciary funds, right? Oops. So let's talk about how revenues are recorded. Remember, in governmental, they're recorded when they're measurable and available, as opposed to when they're earned. So within the governmental funds, like we want to do measured and available. So what's a good example of why money would be available in a period? What's the determining factor there? What does available mean?
If you've received it in time.
Right. What's
within 60 days.
After year end, right? So that's what's going to be available. And if it's not available, then it's going to be deferred inflows, right? Outflows are called expenditures. So let's just get into the type of the actual governmental type funds. So what are they, just off the top of our head? Can you list what the 5 governmental funds are?
The general, special revenue, capital projects, and debt service, and permanent.
Right. Awesome. What type of accounting do they operate on again? Modified accrual. Awesome. What's always a major fund?
General fund.
Right. What's the threshold between determining whether it's major or non-major? What's the general rule? The 10-5 rule, right? So what type of activity is accounted for within a general fund?
Transfers out to other funds, and then just
General stuff, right? And when you think of the purpose of the funds, just really think of the name. The name really tells a lot. So general fund, just general functions of the government. That's their one fund. That's why they all have to have them, because that's where all the main activity comes out of. Then let's talk about. I guess let's just start here. We'll go in order here so we don't get confused. Let's just start with permanent funds. So permanent funds, we know these are permanently held, right? And they're from outside the covenants or whatever placed on us from people, whether it's from donors or whatever it might be, right? So we know the stuff in the permanent fund, stuff has to be held in perpetuity, right? So the funds in a permanent fund are going to be non-spendable, right? Because we can't spend it because the corpus or the principal has to stay intact. Only earnings that are generated can be used for whatever purposes, right? So that's what the permanent fund's going to be for. Capital projects fund, we know these obviously account for money being used for capital projects. By capital projects, we know that's like sewers, sidewalks, buildings, bridges, whatever they might be. We know that capital projects can also transfer money to the debt service fund when there's residual equity, accrued interest, or if there's premiums on bonds, remember, that have been issued, we make those transfers straight to debt service immediately. We know capital projects fund is closed after the project is completed. Obviously, if residual equity is transferred to debt service, then the account's going to be closed, right? If the project's still running, then it's still open until the project's been completed. And remember, these are resources that are restricted, committed, or assigned, right? Debt service funds, we know this is used primarily just to pay debt, right? To extinguish debt. What are the two elements we're going to see within a debt service?
Principal and interest.
Absolutely. Principal and interest. We know debt service funds can act as sinking funds if we have deferred serial bonds or term bonds. Remember, term bonds, they're settled on at the end of a term, like maybe 20, 30 years, whatever the life of the bond is. Deferred serial bonds, obviously, it's the deferred payments that allow us to get some tax revenue in before we start making those payments. So sinking fund, it can act as a sinking fund because we're still going to be placing that money in there. And remember, we're going to be investing it into stuff to make money and using amortization techniques and stuff like that. So it can act as a debt sinking fund, and it also obviously just acts as just a fund just to pay the interest and principal, right? So not bad. There is an exception to this fund. Remember, we operate a modified accrual, right? And under modified accrual, when do we recognize expenditures? Usually,
when the liabilities incurred.
When the liabilities incurred, right? So if we're ordering goods, when we actually receive them, not when we actually order, when we receive them, that's when the expenditures occur because we've incurred the liability. For the debt service funds, there's an exception to that though. So when does the expenditure occur under the debt service fund?
When immediately.
When because debt usually has a time that it's when due, right? So just when payments due, because remember there's going to be installment payments. So the expenditures recognized when due, which makes sense, right? So that's the exception in the modified accrual when expenditures are recognized. So expenditures are recognized when the liability is incurred or when due in the debt service fund because of the payments, right? Revenue is recognized when in governmental.
When it's measurable and available.
Right, and available is
within 60 days of the year.
Right. Okay, so now let's go on to the other one, special revenue funds. Okay, special revenue funds, obviously, other than capital projects, remember, or there's another one capital projects, my head went blank. But anyway, special revenues accounting for stuff not in capital projects or permanent, I believe, or
debt service.
Debt service, right? Debt service. So instead of other two of those, thank you. So obviously, for special revenue funds, we know that this could be like a trustee. Because remember, if someone makes a donation to us for a trustee, it can either go to a special revenue or a permanent fund, depending on whether the stipulation is expendable or non-expendable. If it was going to be non-expendable, then we know that means the principal or the corpus is intact, so that we're going to use a permanent fund, right? If it's non-expendable, it doesn't stipulate between the principal or the interest or earnings, then we're going to use special revenue. And remember, we use those funds for a trustee if it's to benefit the government or the citizens, right? If it's for a special purpose or someone outside the government, then we're going to use the fiduciary fund, the special purpose, right? The special purpose trust fund for the fiduciary funds. So special revenue funds, obviously, special revenue funds for whatever purpose we're using, right? So there's also GASB gave special recognition to this or special guidance to this fund. Do you recall what that was?
It has to be restricted or committed.
Right. It can't be merely assigned, right? So since we're talking about the different thresholds of fund balance within the governmental, we know there's 5, right? Non-spendable, and then there's 4 spendables, right? So we're talking about those. What's the only governmental fund that can have a positive unassigned fund balance? The general fund, right? Special revenue fund, we know it stops with committed, right? It has to be restricted or committed as the lowest constraint. What about the other 3 funds? What's the lowest constraint there? Assigned, right? Because if it's not assigned, it should go back to general, right? Right. Because the whole point in having them in those funds is for assigned for a purpose of the name of the fund, right? So it's kind of counterproductive if you don't have them at least assigned. And then once again, general fund, we know this is always major. We know that every government's going to have one. You can't have more than one, but it's going to be a general fund, and it's just the basic stuff, like it says, basic services provided by the government. Technically, like it says, it accounts for and reports all financial resources not accounted for and reported in another fund. So it's kind of the default fund. The general fund is their operational account, right? In a way to kind of think about this is like companies have different bank accounts. They might have a payroll account strictly for payroll. They might have another account, just for operational purposes. So kind of the same thing. Government's just setting up different funds instead of accounts. You know what I mean? Same thing. So those are the 5 governmental funds. What are they again?
We have the general, special revenue, debt service, capital projects, and
Awesome. And they operate on what type of accounting? Modified accrual. Awesome. All right. Now let's talk about our proprietary fund types. There's 2, right? The 2 proprietaries: enterprise fund, internal service fund. What's the main difference between the 2?
under debt service.
Right. Which one starts?
Enterprise is primarily outside the government.
And they're operating on what type of a basis? Right, accrual, but what enterprise is seeking what? They're concerned with what? Profit. Internal service fund mainly services who? Government, right. And what type of basis do they operate on? Like accounting basis. I see why you're getting confused. Accrual, but what type of basis as far as recognizing like profit or stuff? Are they for profit, or are they trying to just recover in cost? They're trying to recover costs, right? Because they're trying to be more efficient and be more cost. Not saying they can't do it for a profit, because sometimes they mark it up to be able to cover it. Remember, we went through those examples. Sometimes they have to mark it up to be able to cover the actual cost. So that's the main difference. Now, when reporting these to government-wide, do we have to reconcile anything?
No.
Why?
Because they're already in accrual.
Right, and the government-wide is an accrual, right? Now, these appear the same in the fund level, right? Like they appear side by side, right, on the balance sheet or on the income statement or financial statements. I'm sorry, they appear together in the fund level, or like right, but on the governmental side of the government-wide, how do they appear?
The internal services with governmental, and the enterprises with proprietary.
Business-like, remember, business-like activities, governmental activities. But you're absolutely right. One's on proprietary, which is business-like. One's on governmental. So if you just remember that, you're good. So that's the main difference there. One, obviously, because the 2 they're servicing, right? It's for the main function or the right purpose. Okay, the 4 fiduciary fund types. We know we have investment trust fund, pension fund, private purpose trust fund, and custodial funds. The investment trust fund, it says here, accounts for external portion of investment pools governed by a trust agreement in which the sponsoring government acts as a trustee. So what that's saying again, remember, we have a government, right? And we're going to sponsor this program, this pool of an investment. But within this investment trust fund, any external governments that participate, their monies that they invest, we have to keep in that investment trust fund, right? Because it's not our money, right? We're keeping it in a third party. So that's if we sponsor, like if we're sponsoring like an investment trust fund, the outside portions of money need to be put in that. The pension fund, obviously, account for assets to pension trusts for governmental employees, right? So we know what that is. Private purpose trust funds, all other trust arrangements under which principal and income benefit individuals, private organizations, or other governments. So remember, this is the one to where if you don't use the special revenue or permanent, if it benefits like people outside the individuals, that's when we use this one, right, for a third party. Custodial funds, all other fiduciary activities where a trust agreement is not in effect. So that's kind of like the catch-all one, kind of like the general fund way. It's kind of like where there's not agreements. If it doesn't fall in one of these 3, then it's going to go to custodial, pretty much. That's a good way to think of that one. So investment trust, we're a government body. We're sponsoring this investment pooling thing. So external governments and people are going to invest into it. We need to keep their funds separate from ours and put it in that trust fund, right? So that's the investment trust. So easy, just plain investment trust. We're sponsoring it. Pension fund, obviously, we know what pensions are tied to people that work. So that's what that's for. Private purpose trust, obviously it's for a private purpose that benefits people other than the primary government or its citizens, right? So that's an easy way to think of that one. And custodial, no agreements, just your catch-all, okay? But it's still in a fiduciary capacity. Now, when we prepare government-wide statements, where do these appear on them?
They're not on the government.
Right, trick question. They're not on there. Why are they not on there?
Because it's not our money.
It's not our money. We're just a trustee or just fiduciary capacity. Name of the funds give it away. Fiduciary means obviously we're doing it as a trustee, third party, just watching it for other people. So just remember how many funds we need. doesn't really matter. It has to have one and only one general fund, but other types, it's just relative to the purpose of the government. If there's no capital projects, no capital projects. If there's 10 of them, you can use one and itemize them, or you can use 10 different of them. It's really just situational. Let's just look here at chapter 2 here. This was just the broad overview, I believe, is what this one was, of the financial reporting in state and local governments. Okay. Okay, so remember the CAFRE is the Comprehensive Annual Financial Report, right? This is the whole shebang put together from the government at the end of the year. Remember, it has 3 sections: introductory, financial, and statistical, right? Introductory, table of contents, letter of transmittal, stuff like that, organizational chart, just introducing you to the main part of it. Financial, MD&A, we went through this. Auditor's report when audited. Financial statement and notes, they're audited. Required supplementary information, they're reviewed by the auditor, and combining statements, if more details about the main statements if needed. What's an example of a combining statement here?
Would it be a reconciliation?
That could be a combining statement, or if, like, say, if remember how in statement of net positions or in the balance sheet for governmental funds, there could be a column for
non-major.
So we need to attach all the non-major funds that compile up to make that column, right? So stuff of that sort. Just if anything that just needs to be more detailed, then we just attach it to it. That's all that is. And then obviously statistical section, not audited. Information is not financial in nature, and it presents like 10 years of information. So it kind of just gives you different stuff that can kind of just be useful, just tied for governmental purposes. So like this could be some examples: debt capacity, demographic and economic stuff. So we all know what demographics and stuff is. It's just the makeup of a community and stuff of that sort. Governmental reporting entity. Remember how in businesses, for profits, they might have a parent company and a subsidiary if they have a controlling interest in it. Well, same thing. That's pretty much long and short what a governmental reporting entity is. If it has financial accountability over it, meaning, remember, we can assign members of the governing body if we're like financially responsible for paying its debt, and if we have rights to their resources, it can direct them, stuff like that. So pretty much then what that's saying is that if we have that type of control over another entity, we need to include that as a component unit. And if you remember, they can either be discretely presented, or they could just be just blurred in, right? So they could either have their own little item or just blurred into whatever type of activity it would be. Like say if a library was completely owned and everything was verbatim, it was all by default, the government controlled every aspect of it, then they could probably just filter that library into one of their governmental funds and it just be discreetly presented, right? So that's what it's mean. Main thing is, if they have control over it, they need to make it a part of with the report, right? Same as consolidated financial statements. They have to consolidate the subsidiary. Once again, let's just do the required content. So let's management discussion and analysis, right? That's going to be the beginning part of it. Basic financial statements. Let's start with government-wide again. What are the two statements?
Net position, and changes in.
There's only two. So if there's a net position, what's the other thing we need to have? Think of your for-profit. What's your main two sheets?
Balance and income.
Right. So what's the other one we need?
Income.
Right, which is the statement of activities, right?
Okay.
Statement of activities. So government-wide statement of net position, which is balance sheet, statement of activities, income statement. Fund basis, governmental funds, there's 5 of them. We've already established what they are. What statements do they use again?
Balance sheet.
Right.
Changes in fund balance. And then
there's only 2 in this one. Remember the balance sheet and the statement of revenues, expenditures, and changes in fund balance. But you were right, but you forgot the statement of revenues, expenditures, and changes. Just remember, always remember income statement, balance sheet, but just tweak the name. Balance sheet's the same for governmental funds, and then statement of revenues, expenditures, changes in fund balance, which is our income statement. And then we need the reconciliation, right? Because it's different standards of accounting. The two proprietary funds, we've established what they are. What financial statements? I'll give you a hint. There's 3 for these. What are they?
So it's net position.
Yep.
Changes in revenues, expenses.
Right.
And changes in net position.
Yep.
And then cash flows.
Right. Right. Awesome. And then fiduciary funds. What are the 2 in this one? I know we haven't hit on these much, so this is kind of new. It's a little different. So we have the statement of fiduciary net position, and then just a statement of changes in fiduciary net position. So that's kind of easy because remember it's third party, it's not our money, so it's just statement of fiduciary net position, and then how it changed. So the statement of changes in it. So they just want to know what it is and what changed with it. That's it. Let's see here. Okay, format of the statement of revenues and expenditures. So obviously we see revenues first. How are revenues stated?
Revenues are stated by source.
Right, because we want to know where the money's coming from. Less expenditures. Expenditures are related by what?
First by character.
Right, what are the
and
3
then,
characters? You know it. Remember, it's going to be current, which is going to be for your basic operational stuff. Remember, and then there's 2 other things. It's either we're going to either spend money current for current things, or we're going to pay off stuff we've already bought in the past, or we're going to so we're going to either debt outlay, current outlay, debt service, and what's the last one? If we're not doing something operational or paying off debt, then we're probably going to incur more debt. So we're probably going to do what? Capital outlay, right? So current, debt, capital. Those are the 3 characters, right? Within character, how are they displayed?
They're displayed by function.
By function, right. So revenues are by source. We want to know where it's coming from. If the expenditures are by character first, there's 3 characters, either current, debt, or capital. And then within each of the characters, it's by function, because we want to know what character we're spending it on and what function it's being used for, right? And then from there, we do plus or minus other financing sources or uses. What is other financing sources and uses again?
Transfers in and out, and then payment of long-term debt. No.
Not payment, but proceeds. Just bringing it in, issuing debt, right? Because remember, other financing uses is just transfers, right? There's only one. There's only 2 in sources: transfers in and issuance of debt. So awesome, that's it. What about and then it says and special items. What's an example of a special item?
Special item would be something that's within the scope of the government but doesn't normally occur.
Right, and what's their main example?
Sale of land.
Right, land or a fixed asset or something, right? Because we're not in the business of selling property and stuff, so that's a special item. So main thing would be like a fixed asset. But like you said, the main thing is with the control within the scope of the government, still within a control, but not their normal type of stuff. So obviously that's going to give us the change in fund balance, and remember this is the all-inclusive approach right here. So that means the all-inclusive approach is it just needs to be reconciled. So it'll give us the change after we go through the what happens throughout the year, change at the beginning, it'll give us the end. Not bad. And really, by you knowing revenues are by source, you should be able to just almost picture what that statement looks like, because it starts the format. It starts with revenues. It's by source. Revenues, property taxes, fines, forfeitures, fees, you just go on. And then the funds, either it's major or it's not, so you've seen the outlay and you move down. That's why it's so nice to know the formula and know what components make up each one of these elements. You know what I mean? And then you can just see it. And then if you have itemized or you have really detailed journal entries, the statements they're done. So it's really just if you know the theory and the formulas and what enters into it, it's really not bad, is it? Not. I mean, can you almost see like less expenditures? Then you have your three, your current, and it might be like city park, I mean, whatever it might be, then your debt, and then from there you'll see your interest and principal, and then the capital outlay, whatever capital outlays. It's not bad. So there's that. One thing, comparison of cash flow statements again. Let's talk about this. Obviously, commercial statements is FASB, governmental or proprietary statements. Because remember, proprietary is the only one that's concerned, or that's the only place we're going to see a statement of cash flows is in the proprietary funds. We can go through this quick. We just touched it. Direct method is required for the operating section under GASB, right? Indirect or direct is done on the operating section under FASB. What's another name for the reconciliation of from operating income to cash flows provided from operations? What's the other name for that? You could have the direct method or the indirect. So the indirect is the same thing as the reconciliation, right? And we know the differences between one has 4 sections, one has 3, and we know what goes in there. We don't really need to go over that again. We can move on and go somewhere else. Remember the budgetary comparison schedule. What 2 funds is this going to be prepared for? What 2 funds has to have a budget?
General fund, and then would it be special revenue?
Yep, the major special revenue funds. Yep. And remember, it shows the original budget and the final revised budget after revisions during the year. Variance columns is useful, but it's not mandatory. It's optional. So pretty much that's pretty much what the budgetary comparison schedule is. So let's get into chapter 3 now. So modified accrual accounting. So let's just talk about just account structure again, permanent accounts. So we know permanent accounts are going to be stuff that we see like on a balance sheet, right? So obviously assets, we know these are some things we're going to be familiar seeing. Cash equivalents, investments, and the receivables, notes, taxes, accounts receivable due from other governments, supplies restricted. So remember, main thing is assets, deferred outflows, right, of resources. Then we have liabilities, which we know what they are, deferred inflows, right, and then fund balance. Then we know the constraints from highest to lowest, right? Not bad. So it's assets,
Plus deferred outflows.
right,
Plus liabilities plus deferred inflows.
equals.
And plug to fund balance.
Right. Yep. And the fund balance just has to be broken into different things, right? And we remember how when we were building those statements, it has to be relative to the relative account and the relative threshold of whatever, whether it's restricted, committed, or whatever. So wherever they belong, right? Not bad. Same thing, nominal accounts. We know this is going to be our activity accounts, like we would see on like an income statement or the statement of revenues, expenditures, whatever it might be. So those we know: revenues, expenditures, other financing sources, other financing uses. So that's going to be on the activity side, right? So the main thing here is just we know the revenues and expenses are in our other accounting stuff, and then we have other income and stuff, right? So instead of other income, just think of other financing sources and other financing uses like that, like other income or other losses, stuff like that you would see on the income statement like that. Main thing is on the balance sheet is deferred inflows, deferred outflows is matched with revenues or assets and liabilities. With the revenues and expenditures, we have the financing sources and uses. So that's the main differences that we have on those statements, and I think we're familiar with those. We know what those uses and sources are. We've already talked about that. Then remember we have the budgetary accounts as well. Remember when we set the budget, we have the estimated revenues as a debit. Remember, estimated other financing sources as a debit, appropriations credit, estimated other financing uses credit, and then we plug the fund balance, right? The other budgetary accounts that we have, encumbrances, remember, and encumbrances are used for what?
Things that we've purchased but we haven't incurred the liability of.
Right. So when, like I say, if we purchase $100,000 worth of supplies, we would debit encumbrances, and then for $100,000, and then credit budgetary fund balance reserve for encumbrances for $100,000, and that's keeping us within budget, making sure we don't overspend, right? And then when the goods are received, we unencumber the funds, and then we incur the expenditure because why?
Because we just received it.
Now we've incurred the liability, right? And then ultimately from that point, set up the expenditure, the liability, and then relieve the liability, pay the cash eventually. So those are the accounts. Remember, these are the accounts that are closed at year end. Remember, we know that closing process, just the complete opposite of what you do. And where is it plug? When we close these accounts, where's it closed to?
Fund balance.
Fund balance, right? So just current assets. So we're pretty solid on this. Non-spendable. We'll say, let's just go through it one more time. Non-spendable. So non-spendable, we know what items would we expect to see a non-spendable?
You have like permanent fund,
The corpus.
and then you're gonna have like supplies and inventory.
Right. That's it. Right. And remember the difference with the corpus of the permanent account within the governmental funds is going to be listed as non-spendable, but in the government wide, it's going to be as restricted. Remember, there's just a little bit of a difference there, just to point that out. But you're right, non-spendable is going to be your inventories, your prepaids, and the corpus of your permanent account. Restricted, who places that on us?
People outside the government.
Right, and what's an example of that?
Like the federal government.
Like someone outside, like a bond covenant, something like that. So a third party, someone outside has placed a stipulation on us, right? What about committed? Who's put that constraint on it?
People at the highest level within that government.
Right. And assigned, what's a good example of something being assigned? I mean, we obviously assigned it, but who does that? Obviously, we just merely assign it, right? But an encumbrance is a good idea of something being assigned, because obviously, if it's encumbered, we've assigned it for using whatever it is. So if we have anything that's encumbered at year end, obviously we have to unencumber it, but we still account for it in assigned. Because remember, there's not an encumbered section here. Anything encumbered is dealt with as assigned. But obviously, assigned, we're just merely stating we might just verbally say we have an intent to use it for that. And obviously, unassigned is the residual for the general fund, right? Let's see here. We've already went through that. We know these. We know the thresholds. You're doing really good on all this. We're solid on these. Encumbrances, we know. We know about the revenues, other financing sources. We know about the character. Okay, and just we'll look here. Let's see here. I think this will probably be just as an example. We'll go over the expenditure cycle one more time. So, City Council approves the fiscal year budget for the general fund. Obviously, we're going to set the budget, estimated revenues, estimated other financing sources. Those are our debits. Credit appropriations and estimated other financing uses. Budgetary fund balance be the plug. So we recorded it. Note, there's no entry. No entry in the financial statement accounts here. This is just the budgetary accounts. City department issues purchase orders for goods and services. So now we've actually issued it. Once again, there's no entry in the financial statement accounts. It's just a budgetary account here. So we've encumbered it, debited the encumbrance, credited the fund balance for it. Goods and services received, we unencumber it, set up the liability, and then we'll ultimately pay it. So we've got the expenditure cycle down. We know revenue recognition. Okay, this will be our last slide here. We'll call this quits, and then Monday we'll have a more detail. We'll go over some more stuff and have more detail on the exam. Eligibility requirements for non-exchange revenues. Okay, so what do we mean by non-exchange revenues? This is like where, so we're not like, this isn't like an exchange where I give you for something of value and you give me back money or something, right? So that's an exchange like transaction. We're exchanging something of value. In this case, this is where, say, there's like a donor that's created like a scholarship or something. You have to have characteristics, right? So required characteristics to the recipient. Remember, we went through that. If the donor says it has to be a minority of a certain age group, certain income level, whatever, that's the characteristic. So you have to meet those characteristics. Time requirement. They might stipulate. They might donate the money and say, "Hey, here's $100,000 during 2020, but you can't spend it till 2021. So we can't spend that money till 2021. So that's the time requirement. Reimbursement type, like for grants. If it's a reimbursement type grant, if you remember, in order to count revenue, we have to actually incur the relative expenses first or expenditures first. So in order to get reimbursed, so we'd have to record that expenditure. And if you remember, then we go in and record it as revenue as we do it. And we'll go through the journal entries again on Monday. But so that's the reimbursement type. You have to incur an expense and then immediately you offset your expense and set it up as a receivable, right? Then the contingencies on this one, resources pledged to have a contingency. This is where if I say, okay, hey, well, I'm going to donate $100,000 for the renovation of all the parking lots here if you all can raise $100,000. So once you raise $100,000, holler at me and I'll give you the other 100. So that's going to be what the contingencies are. So that's what it means with the non-exchange revenues with the eligibility requirements. You have to meet those eligibilities, and that obviously affects how we account for whatever the transaction is. So that's where we'll leave off today. And like I said, Monday I'll have more detail on roughly how many questions come from each chapter, and the format, true, false, multiple choice, short answer, and stuff like that. And we'll just go through some more of the content to make sure we're familiar with it. And once again, remember the exam is Wednesday, chapters 1 through 6. So with that, I hope everyone's understanding everything. Hope everyone has a good day, and we'll return here Monday and finish up the review. Everyone have a good weekend, and just let me know if you're having trouble with anything.